back. I see you found your instructions on your table and everybody's gotten logged into Kahoot. And we're going to do a little true and false quiz to review the chapter that we finished before our break. There's going to be 10 true and false questions. You'll answer them on your Kahoot on your phone. And then when we're finished with that, we will roll into chapter 14. So the chapter we just did was real estate financing principles. So that's what this quiz is about. Is everybody logged in?
Yes.
Yes. Wonderful. All right, are you ready to start?
Yes.
All right. And the first question, a promissory note is a financing instrument. And these are all true and false. A promissory note is a financing instrument. The answer is true. True. We had one out there.
That was me. I was trying to wake up my phone and I pressed the
False.
keys.
That's all right. You'll have a chance to make it up. Thanks for admitting it, Dennis. Everybody's happy.
I mean, I gotta stand down.
All right. That's all right. All right. So yes, the promissory note is a financing instrument, right? So let's see. Ooh, look, Lisa's in the lead. She answered the fastest. Y'all gotta get fast on the trigger. Let's see what the next one is. North Carolina is a lien theory state. North Carolina is a lien theory state. Again, we got 12 right, 1 wrong. So that is false. What type of state are we then?
Title.
Title theory. Did it kick you out, Sweet Pea?
Yeah.
You can log back in. You'll just lose your points from the first questions. That's the only thing I don't like about Kahoot is if you get kicked out, you lose your points. But you can always log back in and the code is up here on the board so that you have it. Is it letting you back in? Okay. All right. We'll get a new leader. Lisa, somebody's faster on the draw.
Actually, it's me, but.
Oh, sure, good. That might not last. All right, discount points are required for every conventional loan. True or false? The answer is false. Guys, discount points, remember, are just if the lender is choosing to charge them because they had to entice that investor to put their money in that mortgage program. So if they had to dangle that carrot in front of the investor, they've got to turn around and charge it. Ooh, look at that, Travis Tritt winning the beauty. Oh, it's not. Oh, Chris got Travis Tritt. Usury is loaning money to a borrower who does not meet the standard loan qualifying ratios. Usury is loaning money to a borrower who does not meet the standard loan qualifying ratios. Did it kick you out? No. What was usury? Who can remember what usury was?
It's charging an interest rate that's extremely high.
Mandy said it's charging an interest rate that's extremely high. They're charging an interest rate that is outside the legally allowable amount of interest to be charged on that type of loan. That's absolutely right. Good job. Oh, you're still winning, girl. Right? With an adjustable rate mortgage, your payment will stay the same for the entire term of your loan. True or false? Tina's smiling because you know she already talked about her, so she knows this answer. Yeah, look, everybody's right. False, because remember, your interest rate can change up or down, and when your rate changes, your payment's going to change. Guys, what do you think, if you had a fixed rate mortgage, what might make your payment change, Mandy?
Your taxes might go up or your insurance.
Mandy got it right on the ball. She said your taxes might go up or your insurance might go up. We could be optimistic and hope they might go down sometime too, but most often you end up getting a notification that says your taxes have gone up or your insurance has gone up and therefore your payment. But your principal and interest, remember, stays the same on that fixed rate mortgage. Who's winning? Ooh, we're doing good. Close too, it's a close call. Y'all are right on each other's tails. Non-payment of real property taxes constitutes a default by the borrower in a mortgage. Non-payment of their real estate taxes would constitute a default by a borrower in a mortgage. That is absolutely true. Remember, what else could be a default? If you don't make your payments, we already said that. Now you don't pay your taxes, what else did we say? You better get it, Cassandra, what is it?
If you destroy the house.
If you destroy the property, if you don't keep it in good repair, you're in default. And what was one of the others, anybody remember?
Ask permission to make changes.
And Lisa says you have to ask permission if you want to make any major alterations to the property. If you don't, then you're in default if you don't ask permission. Very good. Woo, Lisa, you're back in the lead by 1 point. Y'all are good. Y'all are quick on the draw, too. All right, let's see. What's the next question? North Carolina uses the strict foreclosure process. True or false? Jerry said this game does not like him. The answer is false. Matter of fact, we said that's the method that we don't use. What do we use in North Carolina? What method? Non-judicial, Matt. Yeah, good job. Non-judicial foreclosure. Because what type of document do we use instead of a mortgage document? We use, Cassandra, what is it? A deed of trust. And does anybody remember what we said was built into the deed of trust that gave them the non-judicial foreclosure? I know we just did this a little while ago this morning, so I know it's hard to remember. The power of sale. They get that power of sale clause built in that says, go ahead. If I default, you go right ahead and you sell it. All right, let's see what's next. Ooh, oh, you're down by 3 points now. Deed in lieu of foreclosure is sometimes referred to as a friendly foreclosure. True or false? I was going to mess with y'all, flip them once and put false on the left and true on the right just to see what happens. I will not do that. That would just be me. Yes, guys, sometimes they call it a friendly foreclosure because instead of your property being taken by the bank because you didn't pay, you voluntarily make an agreement with the bank that you're going to give it back because you just know you're not going to be able to keep it. All right, let's see who's playing now. Oh, I went too fast. Okay, if a borrower assumes the seller's mortgage, the seller remains liable for the debt. If a borrower assumes a seller's mortgage, the seller remains liable for the debt. That's not true. Guys, if I assume it, I take it over.
I lost my string.
You lost your string. That's all right, you are in good company. Guys, if you assume the mortgage, you take it over. Okay, you take it over. So you become responsible. Lisa, you're back in the lead again. All right, here we go. We're in a row. Look, Cher's back in the game.
I know, I had 6 earlier.
A lender may be more likely to agree to a short sale if it will net more than a foreclosure. It's the last one. True or false? Absolutely true, guys. If the lender feels like they will make more money in a foreclosure than they will in a short sale, then they're going to go with the foreclosure. But if they feel like they would make more money in the short sale situation, then they would probably approve it. Lisa, yay! You get a free snack from the snack table for winning the Kahoot game.
I followed last week.
You bought last week? That's all right. Now you're good. Okay, so now, guys, we're going to go back into our chapter because we're going to go into chapter 14 now. Let me get my PowerPoint back up. I'm getting better thanks to my technical advisor. I'm learning how to transition. Oh, look at that. Good thing I have students that are smarter about technology than me. Yeah, but I do. All right. So chapter 14 is real estate financing practices. We covered real estate financing principles already this morning and the early part of this afternoon. And now we're rolling into chapter 14, which is on page 304 in your textbook. And right there on 304, it tells you your learning objectives for this chapter are that you will be able to understand some of the components of the recent financial crisis. And I'm going to have a little video I'm going to play for you that's going to kind of explain what happened with that. You're going to be able to define the prevailing criteria for conventional, FHA insured, and VA guaranteed mortgage loans. Identify other types of special purpose financing techniques and loans that are available, and describe how the secondary mortgage market operates and federal legislation that affects the mortgage market, and you're going to learn about residential lending practices and procedures. Some of that we already did this morning when we learned how to pre-qualify a buyer mathematically. So you know a little bit about the debt to income ratios that the lenders will allow people to devote to their housing expenses and their other recurring obligations, which is a lot of the stuff about the lending practices and procedures is talking about qualifying a buyer. So guys, the first thing that we need to talk about is that things have changed drastically since we had our financial crisis. In 2010, the Wall Street Reform and Consumer Protection Act was put into place, and it is more commonly referred to nowadays as the Dodd-Frank Act. And the purpose of this was to prevent future abusive and deceptive lending practices, especially when it came to mortgages. They created something called the CFPB, the Consumer Financial Protection Bureau. And they are an oversight agency for consumer protection, and they have taken under their umbrella 7 different federal agencies are now under the control of the CFPB. And it includes the Fed, which is the Federal Reserve System, HUD, Housing and Urban Development, and the FTC, which is the Fair Trade Commission. They enforce regulations for banks, credit unions, mortgage companies, and all other mortgage-related businesses to try to help keep that mess from happening again. That was the purpose. They administer all the major laws that touch the mortgage industry. Guys, we're going to learn a lot in this class about all of these. They're right here. The Truth in Lending Act. You're going to find out about that today. It dictates what people have to disclose when they're doing advertisement. Have you ever wondered why when you hear a car commercial on the radio, after they've told you all the specials and how much money down and all of that, there's a guy at the end that talks super fast and it comes out kind of like, that's because they have to follow truth in lending as well. So if they're going to give you information, they have to give you all the information. They just do it really fast at the end of the commercial. We're going to talk about the Equal Credit Opportunity Act, about what your rights are with that. The Fair Credit Reporting Act. Most people are now aware, but I can tell you, and Lisa and I have talked about different things. I know we have taken you back to our Stone Age while you've been in class for all you youngsters, but there used to be a time where if you didn't have the ability to go check your own credit. And if you found something wrong, it took an act of Congress to get it fixed. And now they put laws into place that said, hey, wait, we got to be able to fix that. RESPA. That's one of my favorites. That's the Real Estate Settlement Procedures Act. And it governs our real estate closings. We're going to talk about, I told you guys that there have been a lot of major changes in that, and that's why I said there's some sections in your book that are not exactly current. So I'm going to be supplementing paperwork for you when we get to the closing of the real estate transaction, because a lot of things have changed with how we close real estate transactions just since last year, October. It's been about a year now. So we've had a chance to work a lot of the bugs out as agents, we're getting better at it. And then we have something called the Land Sales Full Disclosure Act. We'll be talking about that when we're here on Thursday. And it basically was created to prevent what they refer to it as over-enthusiastic sales promotions, which translates to most consumers as con artists. And so they put some laws into place so that people could not take advantage of consumers when they were selling property across state lines. And again, it's going to be back to mine and Lisa's time, because now you guys will just pick up your tablet or your phone and get on Google Earth. If you want to know information about a property, no matter where it is, you can zoom in and look at it. But that didn't used to be the case when this law was created, so they put it in place to protect us. The next thing they talk about in this chapter, guys, is the Federal Reserve System. The Federal Reserve System has been in place for a long time. Woodrow Wilson was president when the Fed was created. They created the Fed to help maintain sound credit conditions in our country, and they accomplished this by regulating the supply of money and the interest rates on loans. The Fed divided our country up into 12 Federal Reserve districts, and the member banks have to buy stock in their district bank. And the Fed dictates how much money each institution has to keep held in reserve at any given time. Do you guys remember on day one, we talked about supply and demand? What did we say happened if the supply was low and the demand was high to the prices? They go up. Well, that's the same thing that the Fed does to control the money that we spend. When they demand that the institutions keep a large amount of money in reserve, that means they can't loan that money. So if there's only a little bit of money to loan and we all want a piece of it, what happens to the interest rate? It goes up. But when there's a lot of money available, and we want it, but it's not a big deal, we're not fighting over it, those rates go down. And that's how they're helping to maintain sound credit conditions, because they control the flow of money in our economy. You'll hear the phrase, we're going to stimulate the economy. Well, when they stimulate the economy, they give us a lot of money to spend. So we can all go out and get those low interest credit cards and low interest car loans and low interest mortgage loans, and it gets us all buying stuff. And that stimulates the economy. So the Fed has some control over that. So where does the money come from when people want to go out and get a loan to buy a house? We enter into what's called the primary mortgage market. The primary mortgage market is where loans are originated. Remember, we talked about loan origination fees in the last chapter. The fee that the lender charges you for making that loan. What did we say the normal loan origination fee was? 1% of that loan amount. That's right. So we've got the primary mortgage market where the average consumer goes out and applies for a mortgage loan. And I told you when we were talking in chapter 13 this morning that I would tell you about ways that lenders make money off their loans. We know the biggie was what? The interest they charge, right? And we also talked about the finance charges, like those loan origination fees and discount points that lenders sometimes charge on a loan. But lenders have other ways of making money. Do you remember what I said a lot of lenders do with loans when they want to make more loans? Cassandra.
Did it put in a trust, or not a trust, but an interest-bearing account?
Do they put in an interest-bearing account? No, I think you're talking about what we had talked about with brokers putting their trust monies in an interest-bearing account, but that's good that you remember that. Does anybody remember what we said the lenders do? Look, they yelled at you, Cassandra. They sell their loans to investors, right? They sell their loans to investors to get money to make more loans. Well, one of the ways they continue to make money, guys, is they have those investors pay them to service those loans for them. So sometimes when you have that mortgage and you get that letter that says your loan has been sold, they say, but don't worry, you're still going to make the payment to us. You still mail your payment to the same place. We're going to charge a fee for servicing the loan. They don't tell you that part. we're gonna charge the investor a fee to service your loan. We're still gonna collect your payments, and then we'll send it on to them, and we'll charge a fee for it. So that's another way that lenders can make money in the primary market. Guys, the primary players in the primary mortgage market, the major sources of funds, are listed in your book starting on page 307, and they follow over onto 308. Savings associations, insurance companies, credit unions, pension funds, endowment funds, investment group financing, and the ones that we probably see most often in real estate is the mortgage banking companies and the mortgage brokers. Guys, mortgage banking companies and mortgage brokers aren't the same. Dawn, you've been in real estate before, so you know we usually most often take our clients to a mortgage broker, a local mortgage broker. And see, what that mortgage broker does is cast a net out into the financial world and tries to find the best loan product for that buyer. So all those people compete. I tell people it's funny because sometimes you can go to a mortgage broker and get a better deal from Wells Fargo than you would get if you went directly to Wells Fargo. Because when they're competing for business with that mortgage broker, they want to win because they want that mortgage broker to keep sending business their way. So you'll probably encounter that a lot. Did any of you, when you bought a house, use your credit union like Navy Federal or USAA or Marine Federal to get a loan? That's kind of popular here too, because a lot of people, if they bank with Navy Federal or Marine Federal or USAA, that's the first people they'll call when they're wanting to buy a house, even before they'll call an agent sometimes. So we see that too. But mostly we see mortgage brokers in our area a lot. Okay? So that is the primary mortgage market. Guys, the secondary mortgage market are where loans are bought and sold after they've been originated. Remember I told you now, the lenders take all of those loans and they put them together in big packages and they sell them off to investors. And some of the primary players in the secondary mortgage market have been Freddie Mac, Fannie Mae, and Ginnie Mae. Do any of you know or have ever heard of Fannie Mae or Freddie Mac or Ginnie Mae? I knew Lisa was going to raise her hand, and Mandy's got her hand up, and so does Dennis. Guys, when all of this recent financial crisis occurred, and we're going to talk about that, like I said, in a few minutes, and I'm going to play a video for you. When all of this was happening, our government took these people back under government control. Freddie Mac and Fannie Mae buy up mortgages, and then they sell what's called mortgage-backed securities. And whoever is holding those mortgage-backed securities are the ones who receive the monthly principal and interest payments on these loans. And at one point, guys, they held Fannie Mae and Freddie Mac together almost half of all the mortgages in this country. That's a lot of mortgages. But what they did was they would buy them up from the lenders and then they would turn around and sell them to investors. The big difference between Fannie Mae and Freddie Mac, which Fannie Mae is the Federal National Mortgage Association is what it stood for, and Freddie Mac is the Federal Home Loan Mortgage Corporation. And Ginnie Mae in there, that's the Government National Mortgage Association. Fannie Mae used to be a government agency, and when they turned private, our government created Ginnie Mae so they still had a hand in there. And Freddie Mac was a private, company. And so what they do is they buy up these loans, but Fannie Mae would buy up mostly government-backed mortgages, the FHA loans, the VA loans that somebody's guaranteeing. And we're going to talk about those this afternoon because we're going to cover the different types. Freddie Mac would buy the riskier loans. And if you ever have any of you ever watched the New York Stock Exchange ticker tape thing that goes across? Freddie Mac's up there. They sell theirs in the open market. So these were our primary players in the secondary mortgage market, was Fannie Mae and Freddie Mac. Jenny Mae was there, the government side, just to be there to help if there was times of trouble, okay? So, our recent financial crisis, I think everyone is pretty aware that things got a little tough. There were a lot of foreclosures across our country. There were a lot of issues. And I found a really great video that gives a pretty decent explanation of how everything went down. And if my technical advisor has taught me correctly, we're gonna get this up here really easily. Be optimistic. Was it Control F8 that got me my vitamin? FN F8? Oh, F8, there we go. And let's see if I can actually make this work.
What is the credit crisis? It's a worldwide financial fiasco involving terms you've probably heard, like subprime mortgages, collateralized debt obligations, frozen credit markets, and credit default swaps. Who's affected? Everyone. How did it happen? Here's how. The credit crisis brings two groups of people together, homeowners and investors. Homeowners represent their mortgages, and investors represent their money. These mortgages represent houses, and this money represents large institutions like pension funds, insurance companies, sovereign funds, mutual funds, etc. These groups are brought together through the financial system, a bunch of banks and brokers commonly known as Wall Street. While it may not seem like it, these banks on Wall Street are closely connected to these houses on Main Street. To understand how, let's start at the beginning. Years ago, the investors are sitting on their pile of money, looking for a good investment to turn into more money. Traditionally, they go to the U.S. Federal Reserve, where they buy treasury bills, believed to be the safest investment. But, in the wake of the dot-com bust in September 11, Federal Reserve Chairman Alan Greenspan lowers interest rates to only 1% to keep the economy strong. 1% is a very low return on investment, so the investors say, no thanks. On the flip side, this means banks on Wall Street can borrow from the Fed for only 1%. Add to that general surpluses from Japan, China, and the Middle East, and there's an abundance of cheap credit. This makes borrowing money easy for banks and causes them to go crazy with leverage. Leverage is borrowing money to amplify the outcome of a deal. Here's how it works. In a normal deal, someone with $10,000 buys a box for $10,000. He then sells it to someone else for $11,000. For a $1,000 profit, a good deal. But using leverage, someone with $10,000 would go borrow $990,000 more dollars, giving him $1 million in hand. Then he goes and buys 100 boxes with his $1 million and sells them to someone else for $1,100,000. Then he pays back his $990,000 plus $10,000 in interest. And after his initial $10,000, he's left with a $90,000 profit versus the other guy's $1,000. Leverage turns good deals into great deals. This is a major way banks make their money. So Wall Street gets out a ton of credit, makes great deals, grows tremendously rich, and then pays it back. The investors see this and want a piece of the action. This gives Wall Street an idea. They can connect the investors to the homeowners through mortgages. Here's how it works. A family wants a house, so they save for a down payment and contact a mortgage broker. The mortgage broker connects the family to a lender who gives them a mortgage. The broker makes a nice commission. The family buys a house, becomes homeowners. This is great for them. them into a nice little box. This means that every month he gets the payments from the homeowners of all the mortgages in the box. Then he sicks his banker wizards on it to work their financial magic, which is basically cutting it into 3 slices. Safe, okay, and risky. They pack the slices back up in the box and call it a collateralized debt obligation, or CDO. A CDO works like 3 cascading trays. As money comes in, the top tray fills first, then spills over into the middle, and whatever is left into the bottom. The money comes from homeowners paying off their mortgages. If some owners don't pay and default on their mortgage, less money comes in and the bottom tray may not get filled. This makes the bottom tray riskier and the top tray safer. To compensate for the higher risk, the bottom tray receives a higher rate of return, while the top receives a lower, but still nice return. To make the top even safer, banks will insure it for a small fee called a credit default swap. The banks do all of this work so the credit rating agencies will stamp the top slice as a safe AAA rated investment, the highest, safest rating there is. The OK slice is BBB, still pretty good. They don't bother to rate the risky slice. Because of the AAA rating, the investment banker can sell the safe slice to the investors who only want safe investments. He sells the OK slice to other bankers, and the risky slices to hedge funds and other risk takers. The investment banker makes millions. He then repays his loans. Finally, the investors have found a good investment for their money, much better than the 1% treasury bills. They're so pleased they want more CDO slices. So the investment banker calls up the lender, wanting more mortgages. The lender calls up the broker for more homeowners, but the broker can't find anyone. Everyone that qualifies for a mortgage already has one, but they have an idea. When homeowners default on their mortgage, the lender gets the house, and houses are always increasing in value. Since they're covered in the homeowner's default, lenders can start adding risk to new mortgages, not requiring down payments, no proof of income, no documents at all. And that's exactly what they did. So instead of lending to responsible homeowners, called prime mortgages, they started to get some that were, well, less responsible. These are subprime mortgages. This is the turning point. So, just like always, the mortgage broker connects the family with the lender and the mortgage, making his commission. The family buys a big house. The lender sells the mortgage to the investment banker, who turns it into a CDO and sells slices to the investors and others. This actually works out nicely for everyone. It makes them all rich. No one was worried because as soon as they sold the mortgage to the next guy, it was his problem. If the homeowners were to default, they didn't care. They were selling off their risk to the next guy and making millions, like playing hot potato with a time bomb. Not surprisingly, the homeowners default on their mortgage, which at this moment is owned by the banker. This means he forecloses, and one of his monthly payments is a new house. No big deal. He puts it up for sale. But more and more of his monthly payments turn into houses. Now there are so many houses for sale on the market, creating more supply than there is demand, and housing prices aren't rising anymore. In fact, they won't. This creates an interesting problem for homeowners still paying their mortgages. As all the houses in their neighborhood go up for sale, the value of their house goes down, and they start to wonder why they're paying back their $300,000 mortgage when the house is now worth only $90,000. They decide that it doesn't make sense to continue paying, even though they can afford to, and they walk away from their house. Default rates sweep the country, and prices plummet. Now the investment banker is basically holding a box full of worthless houses. He calls up his buddy, the investor, to sell his CDO, but the investor isn't stupid and says, no thanks. He knows that the stream of money isn't even a dribble anymore. The banker tries to sell to everyone, but nobody wants to buy his bond. He's freaking out because he borrowed millions, sometimes billions of dollars to buy this bond, and he can't pay it back. Whatever he tries, he can't get rid of it. But he's not the only one. The investors have already bought thousands of these bonds. The lender calls up trying to sell his mortgage, but the banker won't buy it, and the broker is out of work. The whole financial system is frozen, and things get dark. Everybody starts going bankrupt. But that's not all. The investor calls up the homeowner and tells him that his investments are worthless. You can begin to see how the crisis flows in a cycle. Welcome to the crisis of credit.
Crazy, isn't it? How many of you already kind of knew that that's how it went down? Anybody? Yeah, I thought so. And guys, you got to remember that we all struggled with this crisis. We all had to deal with the aftermath. Jerry.
And that's not, and that event, I mean, it is unfortunate for all those that lost their money, but I mean, for those that didn't partake in that and they still had their own money, wouldn't that have been a good time to go and buy houses in?
Jerry said, for the people who weren't already in it, when everything came apart and you had your own money, would that have been a good time to go buy houses? And the answer to that was yes. And a lot of investors did that, knowing that it's going to go back up eventually. There were people in Florida that were buying houses for 50 cents on the dollar. There were people in the Detroit area, because you know the auto industry pulled out of Detroit, and there were houses selling for 30, 35 cents on the dollar. So if you had the capital and you could afford to hold on to it, then yeah, if you had your own money, it wasn't a horrible time to go put some money back in. Cassandra.
Why did builders continue to build more houses?
Cassandra said, why did builders continue to build more houses? Because it's what they did for a living, in my opinion. And it's hard to stop doing what you do for a living. They just had to back up and regroup. They had to be willing to take a smaller profit, and they had to be willing to try to find some incentives to get people to stay on board. And as we've talked about a little bit in here, guys, we're kind of lucky here in our area because of the military. We're not recession proof, but we're very recession resilient. We didn't bottom out here in Onslow County the way people did in other areas, because here people still had to buy and sell. They still had to move. And so our market didn't suffer as greatly as some other areas. And I think it actually kind of gave some people here a false sense of security. So do you have a little more understanding now of the recent financial crisis now that you saw that? The very first time I saw a video similar to that after everything happened, it just put a light bulb on in my head. Even with all the knowledge I had of real estate, it still was nice to have someone explain it in a way that you could understand it and see how the chain of events went. And it's kind of sad when you think about what they said in the video, that the people who were actually paying their mortgages were like, gosh, we're still paying and our house isn't worth anything now. You know, and so people just walked away, and it's hurt a lot of people's credit. And it's going to take time for everything to recover. But, you know, it's happening. We're on the road to recovery. If you look across the country, things are improving all over the place. But it kind of gives you a little bit of insight into the recent financial crisis. So guys, now we need to talk about the types of loans that are still available to people. By the way, did y'all notice in the video, I want to back up 1 second, that they talked about those loans where the buyers didn't have to prove their income, and they called them no-doc loans. They called them stated income, stated asset loans. When you read in your chapter, when you go home tonight and you read, they refer to them in the book as liar loans. Because what they did was they opened people up to lie about their information so they could borrow more money than they really qualified for. And so they created those loan programs. I can tell you, you're going to be hard pressed to find any of those loan programs now. I got to go to a conference with the Real Estate Commission not long after everything had gone down, you know, where we had this issue. And there was a guy who was with a mortgage company, and he came into the room with a huge bouquet of balloons. And written on each of the balloons was a type of loan that was available before the crash. And he pulled out a hat pin, and he started popping balloons. And by the time he got done, there was only about 4 balloons left, because those were the only loan programs now available. And you know, they ask in your book, who was at fault? In my opinion, guys, everybody kind of was. You know, and it says that in the book. It started with consumers who wanted to buy more than they could afford, so then lenders wanted to try to make it happen because they, you know, the mortgage brokers, they get paid on the front end. They get their commission, like that video said, at the front, so they're good. But it was just a snowball rolling downhill. And, you know.
Who was the last person to hold the snowball?
Jerry said, and guess who the last person was on the snowball, right? Yeah, so we are now on the road to recovery, and it's good, and hopefully we learn from our lessons, and we don't end up back in that same situation again. So now, want to know what kind of loans are still out there available for your clients? We have different types of mortgage loans. There's conventional, FHA insured, VA guarantee loans, which all of you have a lot of knowledge about already. And then we have something called USDA loans, which is, they're often referred to as the Rural Development Loans. And we're going to learn about each and every one of these. Guys, a conventional loan is just any loan that is not backed up or guaranteed by a government agency. When somebody goes out and wants to borrow money and they want to receive a conventional loan, they are going to get the lowest loan-to-value ratio. Remember when we did the loan-to-value ratio math problem this morning? Guys, how many of you used your VA loan to buy your home?
My husband.
Your husband, that's right. And what percentage of the price did they loan you? 100. VA loans have the highest loan-to-value ratio. They give you 100% of the money. Well, with conventional loans, they go, no. There's nobody going to guarantee us our money back if you default. So we're not going to loan you 100%. We want you to put some money down. They have the lowest loan-to-value ratio. They're more secure for the lender. The lender's more protected because, guys, have you ever heard the phrase, you've got skin in the game? The lender knows that if you have money on that table, you're less likely to default. If you put money down, the more you put down, the more secure they feel. So it's a more secure loan for the lender because at least the buyer has something. The borrower has some skin in the game. They put some money on the table. If you want to borrow more than 80% with a conventional loan, they make you buy mortgage insurance. See, when you get that VA loan or the FHA loan, which are backed up and guaranteed, that's the lender's insurance. That's the lender's guarantee that they're going to be taking care of for at least part of their money if you default. But when you get a conventional loan, they go, give us 20% down. And Lisa says, I'm buying a $200,000 house. I don't have $40,000 to put down. And they said, well, that's okay. You can put less down. But if you're going to do that, you're going to have to buy some insurance. And it's called mortgage insurance. We're going to talk about that in a minute. Guys, conventional loans have a category called conforming loans. Think of fitting the mold. That's what conforming means. They have rules about the maximum loan amount you can receive in a conforming loan, the minimum amount of down payment you have to put. It allows for higher loan limits because they have standards set in place. And they also sometimes refer to them as jumbo loans. Do you think those subprime mortgages that they talked about in the video were considered conforming? You think they met the average mold? They didn't. They did their own rules, guys, to help generate more money and help get more people into a home, which, it may have seemed like a good idea at the time, and they felt like they might be helping someone. But, you don't want to put someone behind the wheel of a car that doesn't know how to drive it, so you really don't want to do that, which is why they have rules in place to begin with, okay? So that private mortgage insurance, you know how I describe insurance, guys? A transfer of risk. You get insurance so that if something goes wrong, someone else will be responsible. Well, that lender, when you get a conventional loan, says, look, if you're going to put down less than 20%, we're going to have you purchase a mortgage insurance policy. And it protects the lender for a certain percentage of the loan. If you look in your book, guys, on page 312, it tells you that as of July of 1999, federal law requires that PMI automatically terminate for a borrower if they have at least 22% equity in their home and they are current on their mortgage payments. Because once you have at least 22% equity, if you should default, the lender should at least be able, they think, to break even. So when you get an FHA loan, guys, or a VA loan, they guarantee the lender 20 to 25% equity if you default. That's what they're guaranteeing. So since the conventional lender doesn't have that guarantee, they have you buy private mortgage insurance. And that protects their interest. Make sense? Guys, FHA loans, FHA stands for the Federal Housing Administration. And they don't actually loan money to people, and they don't actually build houses. What they do is back up or guarantee loans that are made to qualified borrowers by qualified lending institutions. And the most popular FHA program, guys, in your book right there says Title II, Section 203B. That is the most popular FHA loan program because it's the program that you would use if you wanted to buy a single-family home. They'll do single-family up to 4. What they mean by that is up to a quadruplex. 1 to 4 family residence, that's what they call it. So remember I told you about the couple that bought the little duplex and they lived in one side and rented out the other? They could buy an FHA loan. They could buy with an FHA 203B loan because they are still an owner-occupant. They don't do investment loans under the 203B program. They have investment loans with FHA, but not under this program. If you go to get a loan for an FHA loan and you want to owner-occupy that property and you want the best rate you can get with the FHA program, the 203B is going to be the way to go. They do, I think, 10 to 30 years, 1 to 4 family residences, and you don't have to buy private mortgage insurance, but they do have the borrower pay a mortgage insurance premium. If you guys look in your book on page 313, it says in addition to paying interest, the borrower pays a one-time mortgage insurance premium for FHA insurance. A lot of people who are not qualified to go VA here in Jacksonville, you'll find when they talk to a lender, they'll decide whether they're going to go FHA or conventional based on what the mortgage insurance premium is for FHA at the time versus what private mortgage insurance is running. Because remember we talked about PITI, what a pity, what did I say that stood for?
Principal, interest, taxes, insurance.
Principal, interest, taxes, and insurance. If you get an FHA loan on top of paying your PITI, you have to pay your mortgage insurance premium up front. And then with and they have a monthly fee as well that's tacked onto your mortgage. And then if you get private mortgage insurance, they tack on a private mortgage insurance premium every month. So I told you guys that when Tony got his loan, he got a conventional loan, he paid money down, but he also got private mortgage insurance because he didn't pay 20% down. So he has to pay PITI, PMI every month. Now, remember now, I said with the conventional loan, once he gets that 22% equity, as long as he's current on his payments, they'll drop that. And the FHA mortgage insurance is a little bit different. Like I said, they don't do investment properties under the 203B program, but they do have investment loans available. And so you have to be an owner occupant of a 203B loan. They also require that you have your house appraised by an FHA approved appraiser. So not every lender, or not every appraiser is approved to do FHA, just like not every appraiser is approved to do VA. And we're gonna get ready to take a break because another hour has passed almost. And when we come back, we're gonna talk about the differences between the FHA programs and the VA programs, which I know that you guys have a lot of knowledge on the VA program, so we'll talk about what you guys know as well. So we're gonna take a break. I'll see you back here in 12 minutes.